Okay, so just a quick reminder, my disclaimer here, the materials presented today are absolutely for educational and information purposes only. This is not investment advice. I'm not a registered advisor. If you want to do any of these things, do them in a paper account, get used to it, try out these strategies, trade options in a paper account for 6 months, 8 months, see how you do before you commit real money to it. And then, of course, you can always consult with a financial advisor. There are going to be different legal, tax advice type things that you're going to want to know about. And so for educational purposes only. So enjoy the show. Hey everyone, welcome to the weekly recap. So a little pullback here today on an incredible week. The S&P down 0.19% today. The NASDAQ, which still hasn't hit its old highs, which is in some ways a little bit of a concern, but I think there's reason to believe that there could be a little bit of catch up to happen there as well. So NASDAQ down 0.36% today. The Dow popping a little bit today, the only one of the major indexes, but yesterday hitting a record above 42,000. S&P, and even though it was down a little today, nothing to be ashamed of. It also hit all-time highs this week above 5,700. So just an amazing display to this week and really the last few weeks of markets climbing the wall of worry, right? That's one of my favorite sayings because it can sort of describe this sort of relentless strength that we find in markets sometimes. We saw it from November to March. We saw it a little bit in the summer, and we've seen it lately. And anyone reading my tweets, watching my videos over the past couple of months knows that I've been calling for rallies. There's nothing at all to be worried about in this economy. I kept repeating it, saying all these things that people are worried about, CPI, FOMC, these are not big deals. Do not get caught as a bear. The data has been very solid. And again, this week we saw good retail sales, online purchases, very, very strong, surged nicely. So people are out there spending. Savings rate down a little bit, but hey, people are spending. Nice revision to the July numbers upwards as well on retail sales. And so stocks have been rising, and that creates a wealth effect. Gas has been dropping, right? And these things effectively equal more cash in people's jeans, which they are all too willing to spend. We know they're using their homes as ATM, that home equity that is up about 80% in the last 4 years. 80% in the last 4 or 5 years. That is unbelievable. There is so much wealth out there. So it really isn't. People have been calling for this recession since January of 2023. Again, January of this year, they were calling for the recession. They're wrong again. People are almost terrified to say the word recession anymore. They've been burned so many times. And so here we are, everyone's spending. So better than expected industrial production as well this week. And so a lot of this data this week, of course, was too late for Powell to consider, but he went with that whopping 50 basis point drop in rates. And even though he can see the data in front of him, it's pretty darn good. And even him, admittedly, he said that the unemployment rate is partially a big supply thing, right? You get a bigger supply of workers from immigration, things like that, and you're going to get a little bit higher unemployment rate. He said nothing to worry about there. But he went 50 basis points. Really, it was 50-50 according to the futures. No one really knew. It was a bit of a coin flip, but really anecdotally, everyone was saying, really, we think it's going to be 25. So it was a little bit of a surprise, I think, more of a surprise than the sort of futures betting line was showing. So this is our first rate cut since 2020. And of course, they made it one to remember. It was the most anticipated FOMC meeting in about 15 years. I don't see anything that really justifies what is almost this kind of, almost like a bit of a panic move by Powell. I don't know if it was all that necessary. And so the 50, people were saying, well, if we get 50, that could be a bit of a source of worry for investors because at least, I mean, not from what markets are doing, but at least anecdotally, they were worried that might mean he's worried about something. He sees something behind the scenes that's happening. And really, I don't think Powell sees anything more than all of us see, and all these terrific analysts and economists and everybody out there making calls. I don't think he can see anything more than what they see. So that kind of worried people a little bit, even though stocks near all-time highs. So kind of a really weird situation. Stocks at all-time highs, so not really displaying much worry, but the VIX up around 18, 19. So that is exhibiting a little bit of worry, right? Typically with all-time highs, you're going to get a VIX closer to kind of 12, 13, 14. Very kind of calm picture, VIX futures curve, very, very calm, which it hasn't been this week until maybe today and yesterday. So, and we brought the VIX down a little bit today, still a little bit elevated. So markets were a little bit nervous from a volatility standpoint, right? So the volatility was where they were exhibiting their nervousness in the VVIX, the VIX, some of these measures that we sort of option people like to look at. But how worried could they have been with markets at actually at all-time highs? So now, for the VIX, we can maybe blame a little bit of that on the market insanity that we had in early August, early September. We had these large volatility events, very, very kind of upsetting volatility events in the VIX, and both the VIX and the VVIX. And so maybe what we're seeing is a little bit of the echoing of what happened there today, still kind of playing itself out. It's going to take a little bit of extra time, a bit like when there's a big storm, a hurricane. People are, even after the event, people are going out, they're buying supplies, getting ready for the next one. It may not come for 10 years, but they're getting ready, right? So there's this kind of volatility and worry echo, vol echo that can happen in those markets, right? And there have been other things, right? The uninversion of the yield curve, and a market that has been somewhat inexplicably suffering from these sort of growth scare gyrations, right? Worried about growth. This jobs number that we had a little while ago, about a month ago, early September or early August rather, kind of set things off. And so we've really been data dependent. Everyone's kind of hanging on every little bit of data that might show that things are getting worse. And they're really not. GDP numbers were really good again this week, almost 3%. The Atlanta GDP firings are pointing down. Challenger firings pointing down. Really, nobody's getting fired. I mean, this it's just not happening, right? It's fiction. Everyone's talking about this sort of worsening labor market, and it really is overall. It's just fiction, and it's incredible how you can see these things kind of play out in markets. Fascinating, right? And it creates opportunity for us. So bless all these moves and different opinions, because these are what create opportunities for us. But really, inflation's under control for now. Rates are coming down. A lot of data looks really good. So in the end, I think that's what everybody cheered, right? It came out, and then after that sort of initial chop that you're going to get on Wednesday, everyone kind of repositioning and getting in, getting out. Especially during expiry week, where there's certainly a bit of jockeying for position happening. Thursday we started to see the real move, and I said that in the community. I said, listen, Wednesday is going to be uncertain, but Thursday we're going to see the real move. And sure enough, that's what we had. We had the Nasdaq jumping about 2.5%, which is interesting in itself, because you might think that the Russell would pay attention to 50 basis points a little bit more. That, as we're going to talk about in a moment. It really makes sense to that sort of small, mid-cap, broader kind of world in terms of the size of that rate cut. So now with expiry today, we definitely had a lot of cross currents, a lot of things going on. Positions being closed, positions being opened. We don't really quite know how much gamma, as they call it, right? That gamma, we'll talk about a little bit of that in a moment. We don't know how much new gamma was created, how much is rolled into new option positions. We'll have to take a real good look at that. We have some data, of course, today from volumes, but we'll have to take a good picture of that gamma profile to know what next week looks like. But we're going to talk about how that actually applies to an NVDA idea that we'll talk about a little bit later in the shows. But we do know that there was a lot of moving and shaking, trillions of dollars in notional value options, huge funds, the JEPIs, the JEPQs, many billions, 60, 70 billion dollars in assets, having to really roll those positions, creating a lot of movement. And the market makers have to hedge. They have to buy back stock on Thursday, then they have to sell it out on Friday when they take on those new positions, those new call positions So a lot of things going on. So really next week is going to be very interesting because sometimes you really get a bit of a change in sentiment from one week to the other because a lot of those shenanigans are over. A lot of the gamma that existed disappears to some extent, and it at least shifts and changes. So we'll see how that may look. So we're going to talk about a couple of cool things. We're going to look at some charts. We're going to look at a couple of ideas. We're going to look at some economic data, which I think is really important because I think we have to kind of frame the way things look. And so let's take a look at where rates are really going to help, right? In small business, I talked about how maybe the Russell could take this 50 cut versus a 25 and really run with that a little bit because that's going to accelerate. Really, what Powell is doing is he's not doing the usual thing that the Fed does, which is kind of just take what's right in front of them and react to it. He's sort of prognosticating a little bit. He's getting ahead of the game, getting ahead of the curve, right? All of the criticism that he's behind the curve. Oh, he was behind the curve when inflation started to go. Well, he's sort of doing the opposite here. He's getting in front of the curve. He's getting in front of this potential harder landing, and he's almost starting to say, look, I'm going to secure that soft landing. That is what we're about. I'm going to secure that soft landing. And the soft landing is what the Russell is going to be all about, and this broadening of the market, right? If we have a hard landing, that means MAG. If we have low rates and a hard landing, that means MAG 7. It means all these sort of strong balance sheet companies that are going to continue to do well. If we secure a good economy, even if it isn't gangbusters, if we have a good economy and things are doing okay and we have inflation down and we have rates coming down, that is what is going to be fantastic for what you see here. You can see real rates have really hurt business sector profits. Look at that, boom. These are the companies, these smaller businesses, they need credit. That is the lubrication for their businesses, right? They are not Apple that's sitting on hundreds of billions of dollars in cash and couldn't care less where interest rates are. These are the companies that care where interest rates are, right? They care about credit and things like that. So this makes a really, really big difference. So we've seen a real suffering on the part of these smaller companies, and I think that is going to make a difference when these rates come down. Here you go. You can see early in the year, we sort of had this big divergence. Look at that between, the sort of CEO business confidence survey, the larger companies being quite confident this year, while the smaller business optimism index stayed very, very low. Look at that. It really, really came down and really never recovered, sort of near those lows of 2020, in fact. So what is on the line? Well, there's a lot on the line, and that's why I think that broadening continues. I've been calling for it for months. I've been tweeting about it. I've been talking about it in my videos. It's been in my newsletter. Look around. I keep telling people, look around. And sure enough, look at these incredible moves we've had in sectors of staples and utilities and everything. I mean, we've seen some incredible moves outside the MAG. So hopefully a few of you have been paying attention and taking and grabbing a few of those opportunities. Here we go. Here we can see since early in the year, we've seen small business optimism actually start to come up, right? And that's ahead. It's actually the same level it was when they started to hike rates, right? So we're talking about optimism ahead of the rate cuts, companies starting to do better. That, to me, this means that there's already good stuff happening in the economy, further evidence that there is no recession. In fact, there is an expansion going on. Where's the recession? We have an expansion in the world of small business, and guess what? Small business is where a ton of employment exists. That is where the bulk of workers exist in the United States. In small and medium businesses, this is what really matters to employees. Of course, we hear about the Microsofts and the tech companies that have fired people, but what happens a little bit behind the headlines, which is in the rest of the economy, really, really matters, and low rates are going to make a big difference. So imagine what happens to confidence when rates actually start to come down. It's going to soar well past pre-COVID levels. is where I imagine it's going to go. So really terrific stuff that could be potentially happening there if this economy holds together, which I think it is. Here's more hard landing versus soft landing. So we've got ISM services, job ads, retail sales, this and that. These things that we've already been talking about all point to everything being relatively okay. ISM manufacturing, a little bit of a hard landing. But again, this is not our economy of 30, 40 years ago, right? The service industries make more of a difference to us. We're not that kind of economy anymore. So there's a small argument there. I know that's not a huge argument, but let's face it, we're much more about the digitization of the world, the innovation on the technology side, and that's what's really making a difference. So a little bit of softness on the part, and we're seeing that in some earnings and coming out, some companies saying, maybe they're not seeing super positive outlooks for the end of the year. So fair enough, we'll accept that things aren't perfect everywhere. Let's take a look here. Friendly reminder, when the Fed cuts rates with stocks at all-time highs. The last 20 times they've done that, cutting rates with stocks at all-time highs, of the last 20 times, the S&P was higher a year later 20 times. All 20 times. 20 for 20, that's a pretty good sign. Of course, that's 1 year out, and things can happen in the meantime, but that's good to know as well. And then, of course, seasonally, Q4, a very, very big outperformer, right? So this is where the seasonality of the sort of sideways action that we get a lot of the time in the middle part of the year starts to go away as we get past that middle of October and towards this very, very strong November and holiday season, and things start to go gangbusters again. So this could be where, managers again, after, last year, they are going to have to scramble to play catch up, right? And so underperforming managers are going to have to redeploy money if they've been falling behind and lagging to try to play catch up from a performance perspective. They do not want to tell their clients, look, we've really, we've really sucked this year, and guess what? We don't even own NVIDIA and Microsoft and these things. Now, the good news is they can own a lot of great things with the broadening out that we've seen, but at the same time, the interesting thing about technology is, if you think of it, lower rates are going to be good for the broader economy, for companies that really need rates to come down, but that is a slower moving mechanism. That's a sort of show me later kind of thing, whereas technology, the driver of most of the profits, of a good chunk of the profits in markets, is really show me now. Right, so this is going to be the sort of push and pull that we're going to see. We're going to sometimes see we're going to see markets go more into the show me later kind of thing because things are getting better, and then they're going to revert back to the show me now, which is the NVIDIAs and Microsofts and all these companies that are generating massive amounts of profits right now. And of course, the AI trade and things that we've seen lately. We saw the power up trade really go bananas this week, right? We saw Microsoft and a couple of companies invest in nuclear reactors, and so suddenly that's putting that on the radar. So stocks like VST, which we own in the community, which we own, going bananas, up 15% today or something like that. So these utility / power gen type plays are very, very interesting. Huge cash flow generating company like VST, a Texas utility, but at the same time with this incredible, foot in the door of the AI game, which is going to demand a massive amount of power to fuel this expansion in what's going on in the world. So very interesting kind of place. Of course, it's had a great run this year. I don't know if it's a great time to get in right now, but these are the kinds of names that you want to look for on nice big pullbacks. Now, we're going to throw a little caution in there, and this is something that I often think about. Forward price earnings, we can see versus sales, right? So you've got sales, of course, they've done well to come back from the depths of the sort of COVID era, and forward earnings have really exploded. And this is really from margins expanding. So no two ways about it. We saw company margins expand greatly in the last few years. And they're passing on inflation and then some, right? So I think there's been a lot of taking advantage of people of saying, hey, well, it's inflation. Haven't you heard? It's inflation, so we got to charge more. So regardless of the cost, their input costs going up, they are really taking advantage of the situation. So if there's one sort of fly in the ointment, it could be, well, there are two. This inflation, right? If the Fed starts to stimulate too much, there could be some inflationary forces that come back. But from a profit margin standpoint, I think there's a possibility that some of that unravels, this sort of incredible free-for-all that corporations had in terms of pricing power and charging people almost whatever the heck they wanted, and everyone going, okay, I guess it's inflation. They really took advantage of that. And so we've got this double top here in profit. Even though profit margins are at all-time highs, there is this potential for, especially with CapEx being a big thing now because of AI and everything, companies having to invest in things like that, that's going to cut into margins as well as potential pricing power coming down. You see things like Airbnb, people are just kind of balking at these prices, right? So, can those incredibly high prices that people were paying continue? Well, they're not. We see inflation coming down, and that could very well mean that we see profit margins come down. So it may be an instance where if that we start to see that happen, you may have to go into the highest quality companies, which I hate to say is probably the kind of Apples and Microsofts, these companies with incredibly wide moats where they can still decide and dictate what they're going to charge people. Right? They're going to say, hey, listen, you want our product, you're going to just have to pay up for it. Whereas maybe in other industries and other areas, the consumer is going to dictate a little bit what companies can charge. So let's take a look here at some charts. We saw the S&P break out nicely above that previous high there. Pop up on Thursday, right? Even on what was that, Thursday? And then we saw, that big move. Then we closed on the low on Wednesday. That was Fed day. Then we popped up huge yesterday and we gave back a little, but we bounced off this nice trend line here, that breakout spot. So we're still looking pretty good. And even today on Friday, I felt like, we had a little bit of a pullback, but I can see the bids are in there. This whole race for the end of the year has started. I'm not guaranteeing that we don't break down because the week after OPEX, after option expiry, can be weird. But if we hang in there next week, I've got to think that things are looking better and better. Here's your NASDAQ. Still well off those all-time highs, right? So we saw this double top in here, even after the Fed didn't quite break through there, failed a little bit today. So we've got you could see the semiconductors really struggling a little bit today, although we'll talk about NVDA in a bit and what might have happened, what might be happening there. So we need the Qs to get up into here. If they can get up into the 490, 492 range, we really could see a big run for those highs there. I'm not sure what's going to get in the way at this point. Here's your Qs. At least we're above this beautiful pattern, this sort of coiling pattern that finally broke out. Fed tried to break out on Wednesday, failed, but maintained that 9 EMA, which is nice to see. But we see this MACD, boom, the MACD breaking out from here. So a nice bit of positive divergence. You see this from this low to this low here. Nice divergence happening there. We didn't get a lower low. We got a MACD that finally started to cross up and looking good. So as long as it stays up in here above, say, 475, above that 9 EMA and this trend line, I think it's looking pretty good. Here's the Russell 2000 as well, almost similar in a way, breaking through this little pennant pattern here, looking really good as well. MACD pushing up. So some good looking charts there from an index perspective. Here's your VIX. You can see that even on Fed day down here did not come off. You see that? And part of that is that, there's still that nervousness. We talked about that volatility echo. And then even yesterday on Thursday, we saw this pullback in the VIX, but not as much as maybe you'd think, right? You see markets doing what they're doing and you're thinking, okay, maybe we'd see a bit more of a pullback, but the only problem with that is that upside volatility is still volatility. So sometimes when you get these big breakaway moves on a stock or on an index, you're actually going to see volatility hang in there. You're going to see the VIX hang in there, or the volatility of whatever it might be, NVIDIA, etc. You're going to see option pricing hang in there because upside vol is still vol, right? That still plays into the calculation and into people's sentiment. So again, a little bit more of a pullback today. So it really feels like we could be heading towards that 15, maybe even a little bit below. But with the election coming and a little bit more data and a few things like that, there's sort of a broad opinion that maybe we really hold that 15, 16 level there, at least through the towards the election. Here's your TLT pulling back. Very interesting, right? Because we saw the 10-year kind of yield bounce a little bit as well. At some point, it's kind of interesting to think that maybe they start to reconsider how many rate cuts we're going to get, because it's hard to believe that we could get 2%, 2.5% of rate cuts and not get some sort of inflation. I mean, this would just be sort of an unbelievably perfect scenario of a good economy, of good employment, of a bit of inflation. It's such a perfect picture, right? It's like this picture perfect, like painting, right? This sort of like a group of 7 painting or something like that. Norman Rockwell painting, right? Is it too perfect? So at some point, do we worry that, the TLT has, I think it could bounce up into here, maybe into the sort of 105 range, but maybe it doesn't get going too far, because ultimately, maybe we don't get as many rate cuts as we think we're going to get. And there could be some supply issues as well on the Treasury side, right? Like there are going to be a lot of bonds potentially for sale. And, is the bid going to be there? Maybe, maybe not. So kind of interesting to think about what that could do. Here's your commodity index, right? So we had this massive breakdown here, which of course is part of that growth scare. Well, what the heck is happening with commodities? There must be severe growth issues in the world, oil breaking down, all these things happening. This does not look pretty for the world. So there are definitely some signs that things aren't great. And we know that. We know things aren't perfect in Europe. We know things are terrible in China. So we know there are problems around the world. But that often means they're gonna run into the U.S. because the U.S. just always wins out. We have consumers who like to spend. Remember these charts from COVID? Everyone else in the world is that savings rate is super high, and the U.S. chart is like spend. The savings rate got drawn down very, 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 very early compared to everywhere else in the world, because it is just an incredible engine of consumerism. And so, this is what's going to happen. People are going to run to things, but to the U.S. and U.S. companies, which are the most profitable in the world and which command the highest premiums in stock markets. And, so there's sort of this incredible gravitational pull that the U.S. has for many good reasons. But, if we see commodities continue to stay weak, we could see if we see the dollar continue to stay weak, maybe we get that pickup in commodity prices again. So interesting to see here. The commodity basket got back up to this line. We'll see if it holds here. Right now, I'm not sure it will. We got a good look here, MACD, and a positive divergence. This is that positive divergence that you like to see. A lower low, but accompanied with this signal line that finds a higher low and then eventually crosses through. Beautiful spot right there to get back in to this DBC index. Okay, let's talk about a couple of ideas. So on the oil side of things, interesting. I've been sort of playing XLE back and forth, and some good trades, some bad trades, generally good, but starting to get on the radar again, right? We're sort of looking at an interesting profile here where, sometimes good trades come about from good fundamentals, from good charting, but from good flows as well. And so we can see here that energy, this is Wednesday's move. We saw energy make a huge move in response to that Fed rate cut. And energy, as you can see, everything to the left of this line and to the right of this line is very positive positioning. A lot of people own these things, right? Utilities are super owned. I wouldn't get super excited about utilities. I know I talked about VST earlier. Careful there, right? So positioning, you can see going in very, very negative. So I think oil is really off the radar for many, many people. And inventories, very, very low. So I'm sorry about the resolution of this chart here, but this is global observable oil inventories 2024 right in here, because we're not through the whole year yet. We can see very low inventories, right? Physical inventories are very low. And here again, we can see these are kind of really cool graphs from Variant Perception. You can see everything in the bottom right quadrant is less crowded space, and top left is more crowded. So you can see gold miners quite crowded, Japan quite crowded, right? Japan's gone bananas. And then to the bottom right, we can see China, but China's got its real problems. We do own a little bit. We're up money on it in the community, but I've collared it because I'm just not sure of how much China's going to bounce at this point. But oil and gas really underrepresented. Really, really a very uncrowded trade at this point, which I like to see, right? These companies in XLE are just making tons and tons of money, right? It doesn't matter if oil's down to $70 or $75. They're making tons and tons of money. And then when we look from a forward PE perspective, we can see that in the left lower quadrant, less expensive stocks from a forward PE perspective and less crowded. So here you have oil and gas, not as good as China, let's say, but we've got to pick the better story, right? Don't just pick the cheapest thing, because we know that can be a trap. We want to pick things that have potential. So we've got this nice oil and gas, metals and mining as well, agriculture, everything in here looking interesting, right? Representing value. Whereas everything over here gets a little bit more expensive, right? EFI growth, very expensive. So what do we do with that? Well, let's take a look at XLE, which holds a number of oil companies, Exxon, Chevron, I believe. So we've got this stock here that hasn't done fantastic, right? It had that great run earlier towards April. And then we've sort of been bouncing around a bit here. This was the growth scare, and we can see it pulling back in here. And so you see, this is an example that I show my students. I look at this and people kind of get in here and they think, well, I'm going to buy this, or I'm going to sell puts in here. And I tell them, what about this looks good? It's pointing straight down. It's ugly. There's no real area that points to any kind of support. Maybe this 200 moving average. But once it gets through there, what are you looking at that makes you think you want to buy this? People love to catch the falling knife, try to pick the bottom. The problem with picking bottoms is you pick it then, and you pick it again tomorrow, and you pick it again 2 days later, and you keep picking the bottom till you're stuck with this crap. And also the MACD line, you can see it crossed down right here, waning momentum, breaking this trend line here. Anyway, that's a little side lesson, but we see that it's actually come back very, very nicely ahead of the Fed meeting, and then it's starting to act fairly well. Now, I'm not all in on this yet. I'd like to see it stay above that 200-day moving average, maybe even get above the 50. I'd say in the sort of 90s, once it breaks through this line here, now it starts to look interesting again, right? An unfavored sector that holds a lot of promise from a cash flow perspective, from a very solid, high capital, big moat perspective. These are generally great companies, like an XOM, fantastic company. Oxy's been struggling a little bit lately, which is interesting because Buffett has been buying that one consistently. I would prefer Exxon to it, but you can play the sector with just something like an XLE and not have to pick individual stocks. So if it gets up in here, I think it starts to look a little bit interesting again. Let's look at the skew on XLE. Cool as well, right? Because so what this shows is that this here is skew, meaning the price of out of the money puts versus the price of out of the money calls, 25 delta versus 25 delta. This says 75, but it means 25 delta put. This is your at the money, 0.5 delta. So this is where the volatilities have been, and you can see that the 52-week average for XLE was up here. So first of all, you've got volatility trading a lot lower, right? That means option pricing, implied volatility, trading quite a bit lower, and even today dropped quite a bit more versus the previous close. And you have skew that was more flat up here, which would have been a little bit better for like a call spread. Now you've got it a little bit steeper, but you're getting to the point where you could almost just pick up some calls, maybe sell some out of the money puts, because it's fairly, even though the volatility is on the lower side, and I don't like to sell it when it's too low, you're getting that nice little bit of put skew there. And you can even use that to buy some out of the money calls, which are cheap. So sell the expensive, buy the cheap. This might set up for a very nice upside profile in something like this. That's something we're going to be looking at in the community this week. So let's take a look at NVIDIA now. So NVIDIA, very interesting from a gamma perspective. So I mentioned gamma earlier, and I promised you that we'd talk about it. So these are very large positions. So at the 120 strike, 119 strike, 118, 121 is much smaller, and then it peters off in here. Very low kind of gamma, right? Where you can almost think of that as like an open interest, but it's a little bit different. And think of dealers being long a lot of gamma at this point. So $2 billion worth of gamma, which means, so if a dealer is long a ton of gamma, that means, or clients, that means they are, but generally dealers are more important to this conversation. That means there's going to be a lot of supply of stock around the 120 and above 120 level as you get close to expiry. Before expiry, there's some supply under 120, but on expiry, it's going to be at 120 and a little bit higher. So when NVIDIA tries to get through 120, as it did earlier this week, a couple days ago, it ran into this call wall. And it just couldn't get through there because there's this massive supply of stock as market makers are trying to sell stock against long calls, for example, right? Or they're trying to sell out their stock against that they had hedged against long puts. So they're getting rid of it above 120 because they don't need to be hedged anymore. The puts are going to be worthless. So there's this huge supply of stock there. So the idea is that maybe after OPEX, and this chart came from Spot Gamma, maybe it's time to consider some upside, because once you take away this huge call wall, then we actually have a profile that, I don't have the chart here, but it shows that there's actually negative gamma from a dealer perspective, which can act as an accelerant to the upside. So I'm not saying buy this thing, I'm not saying do any trades, but I'm saying this is an interesting thing to watch. If we start to see NVIDIA start to move through 120 relatively easily, I think we could see 125 towards 130 fairly easily after that, because I don't think there'll be anything in the way. And if the NASDAQ continues to play catch up, which I think it could very well do, and tech, as I mentioned earlier, is the show me now, not show me later. Show me later is, rates are coming down. That's going to help all these companies that are supposed to do well over the next couple of years as rates come down. Great, that's a broadening. We want to see that in a healthy economy. But show me now is still technology for the moment. And so we might see this kind of catch up towards all-time highs in the NASDAQ. Just because it's feeling left out with all the indexes reaching all-time highs, it's not going to want to feel left out. So let's look at implied volatility on NVIDIA. Another interesting thing, look at that rank, very, very low rank on NVIDIA here, at least from a 30-day volatility perspective, right? So shorter-term options are cheap, right? They're cheap for NVIDIA. Look where they normally trade. 52-week average up here at the money, up around the 49 level, 48.5 level, and right now down around the 45 level. And typically if that flat skew, so a little similar to the XLE, you're seeing this kind of lower sort of inverted skew, which is pretty normal. It's certainly normal for an index and often normal for most stocks, right? NVIDIA going into two earnings reports ago was like this. So people were paying up for upside. The call skew was insane. People were paying up a lot for it, for those calls. So, but right now we're not seeing that happening. We don't have an earnings report in the next 30 days. So we have this in the near term. So we have this relatively low skew. So this also argues for low vol and cheaper upside. This is potentially an opportunity to maybe buy a call spread, even though they get cheap. You're going to have to sell those calls a little cheaper here, but call spread is going to cut down on the cost of playing that upside. Or you can just grab maybe a call up here and see what happens once you see NVIDIA get through 120, 121. So a couple of ideas for you there, and that's here's what this is going to look like boom, here's your call spread. You can spend $3 right now on a Dees 120, 128 call spread. Spend $3, and the whole spread is going to be worth 8. So spend 3 to make 5 kind of thing, but you have the rest of the year for this catch-up trade to really play out. And if things get crazy again, maybe volatility rises, although NVIDIA may struggle a little bit if that's the case. So, but an interesting way to play this. There are other ways to play it, but I wanted to keep it simple today. You can obviously go in and just buy a call. I like a hard call. I don't like a soft delta. I like a hard delta. So maybe buy like kind of an at the money for March or next June. Gives you, but be very careful what you're spending, because of course you can lose all your money on a long option. You can just lose all that money. So it's something you want to give. You want to be patient with it, and maybe pick a spot where, look, if it breaks 110, then I'm going to pull the ripcord on that. But that's also an interesting way to play. Some people like to pick up some leaps, so very, very long-term options, and play that upside. As NVIDIA, I think it's going to probably head to 140 again, near those old highs. So that's it for today's show, guys. I know that was a lot. Hopefully you learned something. Right now I've got a flash sale on this weekend, $397 for my Crush the Premium Enhanced Wheel Option Selling System. Goes over all the pillars that I look at. Risk management, risk gauges, and that's what you also get in the community. You get 6 months in the community with hedging ideas, chart packages, trade ideas, just a ton of amazing stuff, and really great traders, super, super smart people in there. And then also there's my bundle for $777, which includes the Crush the Premium Wheel course, which it includes the Gamma Options Mastery course, which is 16 hours of videos that talks about all kinds of strategies. The Enhanced Wheel also has a absolute beginner bootcamp program. So this program will start you right from the very beginning. And in the bundle, you also get the Iron Condors course as well, which is an incredible low correlated approach to being an option seller. Terrific. And then 6 months in Discord. So the 777 deal is really unbelievable. You get all this great stuff. And if you just want the Crush the Premium Enhanced Wheel course, $397, regular $999, you can't beat that for top-notch learning. And look at the amazing reviews I've had. Here's Jeff. He made 15 grand on a caller. So I teach you callers. I teach you defense, not just offense. If you don't learn defense, you're not going to make it in this game. So I teach people defense. He made 15 grand on a defensive strategy with the SMCI caller, 200% in a single day on his AVGO caller. So, you save a penny, make a penny, right? A penny saved is a penny earned, is the saying I was going for there. And staying out of the bad trades is just as important as finding the good trades. And that's what long-term success is about. So hopefully you guys enjoyed this, and we'll catch you next time. Have a great weekend.